Good morning from London. I'm Anna Edwards alongside Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Another big day for earnings in Europe. BNP Paribas gets a boost from its investment banking unit, while Societe Generale posts a beat fueled by securities trading and reshuffles some management. We will bring you numbers from Maersk and Shell shortly. Big tech disappointment. Instagram owner Meta falls as it warns investors about heavy spending on AI and on other infrastructure. Microsoft slides on a slower forecast for cloud growth. Plus, Governor Kazuo Ueda indicates the BOJ is on track for further rate hikes after the central bank stands pat.
In the meantime, a quick check on these markets. I'm going to work my way from the bottom up because as we get those comments from Governor Ueda, you are seeing more strength in the Japanese yen. He specifically commented on the weakness of that level, pushing, again, more green on the screen, more thoughts of intervention when it comes to the currency. That is in contrast to what you're seeing in China, where, of course, another weak set of data is pushing the Asian stocks, the entire region, down lower by about 0.2%, currently pairing some of those losses, but certainly feeding into risk sentiment in the futures picture here in Europe. And we are seeing Euro Stoxx futures down by 0.7%. The FTSE 100 right on its heels in the red as well. The countdown to the opening trade starts right now.
Welcome to the programme, everybody. Thursday, the 31st of October. It is Halloween. Markets might look a little scary if you're long right now. We have the futures picture in Europe is weaker. The future picture in the United States is weaker. A lot of it has to do with US tech and other earnings. We'll get to those. Let's deal with some of the earnings coming through in Europe, though, right now. We have Maersk, the shipping business, then, Kriti, in focus. And to be fair to this company, it would be a surprise if there were a surprise today, because we heard from them on October 21st when they pre-released a lot of the details. They increased their guidance then for the fourth time in less than 6 months. And what we see today is that they beat estimates on their EBITDA number, and they're sticking to their full-year underlying EBIT and EBITDA guidance. So I suppose no surprise there. When we speak to the company, though, we'll definitely want to get updates on Suez, on what a Trump presidency might mean, could mean, tariffs broadly, strike activity on the East Coast. Lots to discuss.
Lots to discuss. Also, so much of their outperformance has been a function of those higher shipping costs. Now that we've seen those come down a little bit, how does it show up in their numbers? The logistics and services revenue coming in about $3.9 billion. The estimate there about $3.7 billion as well. But kind of related to that is what's going on in the oil markets as well, in the oil story.
Yeah, absolutely. We've got Shell with their numbers out this morning. Third quarter adjusted profit coming in above estimates, $6.03 billion. That is above the 5.39. They're planning a share buyback program of $3.5 billion, and that number is crucial because there had been some in the market that suspected we might see a drop, a cutback in that buyback level. Analysts were kind of divided about that, and we haven't seen that, so they're sticking to that buyback at that particular level.
Yeah, the timing is really crucial here, especially when governments across Europe are considering windfall taxes and the extent of those, specifically on the energy markets. That's going to be something we keep an eye on, as we also will be keeping an eye on what's going on with Stellantis. Their numbers coming out, their net revenue there about just shy of $33 billion. The estimate was a $36 billion. At least that's on the net revenue perspective. When you look at the operating margin, though, that's where you're seeing the pain. And this is perhaps a very disappointing number for a company that's dealing with some of these kind of strike issues, as Anna had mentioned, but also some of the overcapacity as well. Operating margin being downgraded to 5.5% to 7%. Estimate was 7.1%, Anna. Not a good day for Stellantis.
Yeah, not a good day for Stellantis. Let's move on to what seems to be weighing overall on sentiment. Certainly in the US futures, you see this very clearly with Nasdaq futures down 0.9%. And that's some of the tech stories we've had overnight, Kriti. Weak guidance coming through on Azure, on the Azure cloud. And I'll read some of the numbers here because I think it's important to get a sense of the scale here. They had 34% growth in Azure last time around. Now they're talking about 31 to 32%. So these, they're not a huge miss, but this is a market perhaps priced for perfection. And therefore that kind of miss goes down badly with investors. But it is interesting to see that one of the reasons they can't live up to demand is because of data center capacity. This is a supply constraint. It's not because there isn't demand out there, which I think is crucial for how much this matters to the wider AI story.
It absolutely does. And it's fascinating here. This is the curse of Microsoft, that even outperformance of, say, 32% growth, so many other companies would kill for it, and yet they are getting punished by it. But to your point, the effect that you're talking about, showing up mostly on their margins, which I think is interesting. Yet you've seen sensitivity in the S&P 500 to the margin story. Microsoft being kind of this heavyweight and almost stalwart of the tech industry, really not setting a good tone. Meta, on the other hand, showing a little bit of a different result.
Yeah, right, but still warning about investment. And that seems to be something that the market is really nervous about right now. You know, you're investing heavily in AI themes. You're investing in all kinds of initiatives over at Meta. What are we seeing in terms of payback? And we saw markets really worried about that a few years ago. Now we live in an AI universe. Markets may be a little more easy to reassure around that investment spending. So their Llama, large language model, and other projects, the metaverse, AI-powered glasses, all of that, all gets increased investment, and that is something that spooks the investors a little.
Yeah, it does, especially at a time when tech is and may still be that defensive trade. If you're looking for kind of hedging that volatility, is it the tech trade or is it your traditional havens like the yen, for example? That's where you're seeing a little bit of strength this morning. Taking a look, especially after the BOJ comments, no change in the rate decision, as you mentioned in our headlines there, Anna. But this idea that they're keeping one eye on that weakness in the yen, yet again, they're bringing up this question of whether or not intervention is actually on the table. It's enough to move the yen, dollar yen this morning. We're looking at a 152 handle, again, in favor of the Japanese yen. Yeah,
really interesting to keep an eye on some of these Ueda lines, because you'll remember when we got that interest rate hike from the Bank of Japan in the middle of the year, or August was it, and it caused a huge amount of volatility, that and some US data and some other factors in the markets. And it was later remarked upon that by Ueda that there was that markets were unstable, and there was a sense that they wouldn't hike again if there was going to be instability in markets. And he said today that markets regained stability, and it was just after that that we saw that jump a little higher in the yen, and I wonder if that is something that the market is digesting. Interesting, though, that the yen moves in the different direction today from the direction of travel that we've seen. It's been kept under pressure by higher interest rates over in the United States and elections looming.
Absolutely, and reflected in the stock market as well. And, of course, this is coming in line with everything that we're seeing in the banking sector. I'm not even sure where to look at. There's so much news, but I think the banks, the European banks, is where we go next.
Yeah. Absolutely. Let's get to the BNP story. We've got numbers coming through from BNP this morning. Investment banking and asset management markets, two of the markets that boosted the business, but the lending business perhaps under a little more pressure. Let's get to Lars Machenil, the BNP Paribas CFO, who is with us this morning and can weigh in on the performance of the business. Lars, let's look back a moment then at what you have reported. Some strength coming through in IB and in asset management. Do you sense that the things that produce the strength can be continued into the rest of the year?
Anna, first of all, good morning and great to be on your show. And as you've seen, it's Halloween, but our results are not scary at all, right? On the contrary, they're basically strong this quarter. Yeah, and if you look at it, if I take just a step back, overall at the bank, total revenues are up 2.7%, bottom line up 6%, earnings per share up 11%. And indeed, if you look at the three businesses and if you zoom in on CIB, what is the reason why our CIB is doing well? It's really doing really well. So it's up, the total CIB is up 9%, and it's basically three divisions, and all of them are doing well. So it's firing on all cylinders. So our global banking is up 6%, securities services is up 6%, and the one you're hinting at is our global markets up 12%. And there again, why is it strong? If you look at it, the equity business, so equity and prime services up 13%, and the FIC also up 12%. And so what is basically happening is what we see is BNP Paribas. We are ready in the sense that we have the capital to support our clients. We have all the services, both in equity and prime services, both in all the letters of FIC. We have all available. And so therefore, we can serve our clients with all those services. We can take up market share. And so we basically drum to a rhythm which is faster than the underlying economy.
OK, that's interesting. That's an interesting way of expressing it. Thinking about the underlying economy, Lars, are you seeing that being impacted by political uncertainty? There's plenty of political uncertainty to go around these days, but we've seen quite a bit of that focused in the last 6 months or so in France.
If you look at it in general, we are a pan-European bank, right? 70% of our balance sheet is in Europe. And so that is the focus of where we're active. And what we see is that there is a need in all of the countries and in Europe as general to go for structural investments, investments related to the sustainability, investments related to bringing back or bringing technology and infrastructure in place. And so that kind of financing will need to happen. And that financing will need banks, and in particular banks that can originate and distribute. So basically link the investments need with the desire in Europe to invest. And so that is for us, BNP Paribas, which is very pivotal and that we consider will be intrinsic on what Europe needs.
Well, Laura, speaking of what Europe needs and that stability that you're speaking to, it does feel like when we talk about the domestic situation within France, you have seen some realm of stability, although perhaps not reflected in the bond markets. Those spreads between OATs and bonds haven't quite closed yet. How does that show up in your business? How much pressure are you feeling from that spread widening?
Listen, we are not a bank that is basically doing business by just investing in OATs or others, yeah? So for us, the key thing that we do is accompanying corporates and affluent customers in what they're seeing. And that is basically what we're doing. So whatever, and so we are very, again, distributed. So if 70% of our balance sheet is in Europe, basically 20% is in France. So we are distributed. We are basically serving the clients. And that is the core of what we see and what we will continue to do.
Let's talk then a little bit about some of your other parts of the business. You talked about the CIB unit as well. I'm curious about your asset management story. This morning, we've had a slew of bank earnings from across Europe, and so much of that has been a question of fee income as a means of making up for some of the declines in net interest income from, again, a function of the rate cuts. Talk to us a little bit about the bid for AXA as well. Do you have your eye on other companies? What does that look like?
Yeah, listen, as you mentioned, for us, the IPS division is the one that is really focusing on that fee business, yeah? So we basically said this is what we want to grow further. So we already had a very solid insurance player called Cardiff, and we had a relevant asset manager. With the deal we are finalizing with AXA IM, we will basically get further strength, yeah? We will get further strength because we now have 2 distribution channels. The one of AXA, the one of BNP Paribas. We will have a combination of products which will make a very versatile and diversified set. On top of that, we will get scale. So that is very important, and that is what we will continue to do. So we're very pleased with this. We're going to set all sails to make it happen, and it will make an important change and service provider and fee generator for the bank.
Yes, and lots of banks are looking for those fees, as Kriti was pointing out then, Lars, as opposed to being so reliant on the net interest margin. Can you tell us about the reactivity of BNP Paribas now to cuts in interest rates? Because the market is expecting the ECB to keep cutting interest rates, and I wonder how responsive your business will be to that.
Yes. Listen, if you look at it, the main thing is... I've lived the 70s, yeah? And in the 70s, what I mean by that, you saw runaway inflation, then getting a reaction leading to a kind of recession. So the main thing was that if Europe, whatever the economies, could avoid that. And so what I'm seeing at the ECB is that they are setting all sails for that to happen. So it looks like they've already avoided the runaway inflation. Yeah, and from whatever I hear, or I see them do it, they will also avoid a recession. So that basically means, yes, they will use the speed and the amount of tapering they will do in order to strike that kind of economic balance as they have been doing. So from that point of view, for us, that is fine. We're adaptive to it as long as they remain into this zone, and we see everything, or at least what we hear and what we see them do, is that they put all sails to stay into that zone.
Lars, I want to bring this back to another part of the business. As we talk about this macroeconomic environment, perhaps deteriorating, I'm curious specifically about your emerging market presence. We've seen job cuts at BNP in New York and London, specifically in that EM credit team. What is that in response to? Is that a macroeconomic situation, or is this a competitive story when it comes to perhaps dealing with EM banks that may have more local exposure?
Listen, you should not read any into this. Yeah, we have a strategy going forward. We stick to that, and then we optimize. And those optimizations can happen left, right, and center. Some activities can move. We are acting to some competition. So you should not read any strategic evolution into this.
Lars, thank you. Thank you very much for your time. We appreciate it. Lars Machenil, the BNP Paribas CFO, friend of the programme. Thank you for coming to talk to us at 7:13 here in London. Lots happening this morning. Let me tell you what we have coming up on today's programme. Exclusive conversations, in fact, with Luisa Gomez-Bravo, the CFO of BBVA, and César González-Bueno, the CEO of Banco Sabadell. So we have the Spanish banking story, the earnings and the consolidation, perhaps, all tied up. We'll also be joined by Vincent Clerc, who's the CEO of Maersk. Lots to talk about when it comes to global shipping. At the opening trade, Sharon Bell, Senior European Equity Strategist at Goldman Sachs, will be with us. She can weigh in on some of the post-budget reaction we've seen in markets here in the UK. Lots to talk about this morning. This is Bloomberg. Welcome back to the programme. 7:18 here in London, and it's a weak picture developing across European equity market futures. Euro Stoxx 50 futures down by 0.7%, and US equity futures also looking weak. E-minis down 0.75%. Kriti, Nasdaq futures down more than 1%, and that's really the Meta story, the Microsoft story, all of that going down pretty badly with investors, it would seem, after those results came out. Let's talk about some of the European earnings stories that we're going to have to fold in here as well. We've already dealt with the banking sector through BNP. But let's go to SocGen, sticking with France. We got numbers there that were better than expected, but some really interesting changes, developments, movements at that business. They're talking about the deputy CEO and the CFO both leaving the business, and more direct supervision of various units from the CEO seems to be part of the goal here.
Yeah, it's a fascinating one as well when we're talking about kind of where you navigate or where you get some of that revenue from in a decelerating interest rate environment. I'm having a little bit of deja vu here, Anna, because the last time we were talking about rate cuts, so much of it said if we're not going to get the net interest income, maybe the trading activity, the volatility can make up for it. And instead, you're actually seeing a lot of these banks in Europe, shockingly, rely on that investment banking fee revenue in the absence, I should say, of that net interest income margin as a function of rate cut expectations. So I think this is fascinating when we talk about that, and also this background of consolidation. And that's where this BBVA and Sabadell conversation I'm very excited for. Two exclusives from two of the main folks in Spain that could shake up not only how consolidation is viewed across Europe, but how the domestic Spanish banking sector works as well.
Yeah, absolutely. So that'll be certainly a focus for us as we go through this programme. So 7:40 UK time, the CFO of BBVA, and 8:30 the CEO of Sabadell. Lots to talk about there. Let us pivot to a conversation about the UK, though, because we've had plenty of news flow over the last 24 hours on that front. Labour's first UK budget in over a decade raises taxes by £40 billion a year to fund a £70 billion annual increase in public spending. Chancellor of the Exchequer, Rachel Reeves, has promised that the plan will end austerity and break the grip of economic stagnation.
This government was given a mandate to restore stability to our economy and to begin a decade of national renewal. Yeah. To fix the foundations and deliver change through responsible leadership in the national interest. That is our task, and I know that we can achieve it.
For more, we're joined by our UK correspondent, Lizzie Burden. Lizzie, you and I were listening intently to this yesterday, digesting it as it happened, and then witnessing the post-delivery market response. 40 billion, that got a lot of headlines. What were the key takeaways for you?
Well, Anna, the bottom line for me is that this is a fundamental expansion of the British state. As you say, a £40 billion tax hike in total. It's the biggest tax rise since Norman Lamont in 1993. But many of the increases well trailed. We had the rise in inheritance tax, capital gains tax, employer national contributions as well. But if we flip over, for all of the increases in taxes, all of the increases in spending, actually, if you look at the Office for Budget Responsibilities projections that came out alongside this budget, the GDP forecast, not that impressive, perhaps. Remember, Labour's target is 2.5% annual growth. It only marginally boosts growth in the short term, and by the time you get to 2029, 2030, it's actually a drop in GDP growth compared to what the Conservative plans would have done. Now, anemic growth, but if we flip the board over, you're also expected to see, according to the Office for Budget Responsibility, more inflation. That comes down to the rise in the national minimum wage, the increase in borrowing of £142 billion, and therefore that's expected to slow how fast the Bank of England can cut interest rates. This is the OBR forecast. You can see what they expected in March and now what they expect according to the latest projections there in yellow. And so traders have backed this up as well, and we saw this reflected in the gilt market reaction, as you mentioned, Anna. Let's flip the board and you can see how gilts were faring throughout that speech by Rachel Reeves. Here's where she stood up and took to the dispatch box, and here's where she sat down. So the market reaction pretty sanguine given all of that pitch rolling, and as it was all trailed mostly, it was pretty normal there. And then we had this ferocious sell-off afterwards once she'd stood up, and this is the reaction to the repricing of the BOE after that. Anna?
Yeah, absolutely. That's certainly getting a lot of attention. We will return to that theme shortly. Lizzie, we need to get back to some of the earnings stories that we've had out this morning. So I'm going to go straight to Maersk and the CEO of Maersk, Vincent Clerc, who's standing by for an important conversation about global shipping. Vincent, thank you very much for bearing with us this morning and coming to speak to us. So you upgraded your guidance earlier this month, in fact, 21st of October. Can you talk us through how much of the strength you're seeing is to do with fundamentals of demand and how much is to do with higher freight rates? Give us a sense of those drivers.
Yeah, you have obviously both drivers playing a very intricate role. I think the big story for this year has been the strong market demand that we have seen throughout the year. We have seen imports from Asia to Europe grow 8% over last year, growth into the North America from Asia in double digit. And that growth has really put a lot of pressure. If you add to this the disruptions in the Red Sea and longer sailing routes, then you've had shortages of capacity, which in return have also pushed the prices up. It is mainly a price issue with respect to earnings, but I think that the underlying growth that there is in the market and the strong demand is really one of the key fundamentals, and that seems set to continue at least for the rest of the year.
OK, and what does that mean in terms of your ability to return cash to shareholders? Vincent, you suspended your share buyback earlier this year because of what you referred to as a gloomy outlook. What can we expect to see on buybacks?
So, first of all, we'll continue to pay out significant dividends on these earnings next year, and then we have to see still in this very, very volatile situation how this is going to normalize. The disruptions around the Red Sea, the reopening of the Suez Canal is one of the big unknowns. We see this disruption go well into 2025 at this stage, and as this starts to fall back into place, then we will be able to come back with more clarity on our financial policies.
How concerned are you about global trade, Vincent, at a global level, given what might happen depending on who takes to the White House and the amount that even the Europeans are relying now on tariffs?
I think what we're seeing so far is an incredible resilience of trade to these macroeconomic disruptions or these trade policy disruptions. But we're also seeing growing imbalances. Demand is very strong from export to Asia into Europe and North America, but we're seeing actually that this strength is not replicated in the trade that is going from North America or from Europe into Asia. And while it is good to see that strong demand on imports, the fact that the gap between import and export is increasing is a cause for concern for us in the long run, something that we're following closely.
Vincent, thank you very much. I think that's all we have, all the time we have with you this morning. So thank you. We appreciate it. Vincent Clerc, the CEO of Maersk, giving us the top lines on the numbers, the drivers behind them, what they'll be able to return to shareholders and the global trade picture. We thank him for his time. We'll return to some of these earnings themes. We'll continue to keep track of what's going on with US futures, which do look pretty weak on the back of some of those US tech earnings. We'll also continue to digest the UK budget. We were hearing from Lizzie about some of the headlines there. We'll talk about the tax impact on business next. This is Bloomberg. Welcome back to the opening trade. 30 minutes until the opening trade for this Thursday morning, Thursday the 31st of October. The futures picture for Europe looks a little weaker, perhaps sentiment damaged a little by what we've heard from the United States. The numbers out of Microsoft, for example, weighing on sentiment around AI. To what extent that's justified, we'll continue to weigh that up. But we've got European equity market futures then seen a little bit lower. We also have US futures seen lower, down by 0.7% on E-minis right now. Let's have a quick look at what's going on the bond markets, but because we do see there's been a lot of focus on just how quickly we'll see rate cuts from the ECB in recent weeks. Today, we see a different focus in markets and those yields climbing just a little bit. France, Germany, Italy, just up a few basis points this morning. Of course, we'll wait for another half hour until we get the opening of the gilt markets to get a sense of where that trade goes from here. We saw a lot of volatility in it yesterday. And the source of that volatility, of course, was the budget, the run-up to it and its aftermath. Let's talk about the budget from a tax perspective, though. Labour's first UK budget in over a decade raises taxes by £40 billion a year to fund a £70 billion annual increase in public spending. Let's bring in Amanda Tickell, who's global leader for tax and legal policy and regulatory sensing at Deloitte. Amanda, really nice to speak to you this morning. So there's lots to talk about here when it comes to the response that business might have from a tax perspective to all of this. Would it be fair to sum it up that small businesses might not be too unhappy this morning, bigger businesses more unhappy this morning? How do you sum up what we've heard?
I think that's a fair summary. We were, I think, surprised by the size of the tax rises at 40 billion. Big businesses clearly seem to have the largest shoulders here because the rise of national insurance that they have to pay on employing people is going to cost 25 billion. So I think businesses today, particularly large employers, are looking at exactly how much that is going to cost them and what they're going to do about the possible impact to their profit margin.
But from a small business perspective, yes, they pay that too, but there were some offsetting other measures that sort of dull the impact of that. Talk us through some of those, Amanda.
Yeah, there was definitely a focus to the smaller businesses. There is a new employment allowance, for instance, so around 200,000 very small businesses won't pay any employer's national insurance at all. So good news for some, but the majority of the bigger businesses will be facing a cost.
How sustainable is this strategy in terms of these tax rises? And I ask this in the context, I believe the OBR came out on the back of it and said this might have a little bit of a sugar rush in the short term, but for the long term, in the next 5 years, this is not consequential to fixing some of the structural issues. 12, 24 months down the road, what does tax policy look like?
Yeah, well, I think that at the moment this is going to take us to a historic high in terms of tax to GDP in the UK, the direction it's going. So there is only so much, I believe, you can tax. Now, what the Chancellor's also interested in is investing in the UK economy. So we heard this invest, 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 and she's extremely keen that all this public sector investment is matched with private sector and that the UK becomes a more attractive place to invest.
When it comes to that attractiveness, who are they competing with in terms of tax policy? And this is not just the UK that's talking about these tax rises. France is a great example of this as well. What lessons can be learned there from what they're seeing on the other side of the channel?
Well, the latest French budget actually introduced around 40 billion euros of tax rises, so it's actually a similar story there. I think, we are, these days businesses are pretty mobile and so are individuals, so I think obviously it's where your nearest competitors are, but it's a global market and they'll be looking at tax rates all over the world. They have chosen to cap the rate of corporate tax, very keen to give businesses certainty here, and published a roadmap which also maintains the rates of R&D and the regime. So innovators will be very assured, actually, by this budget.
That's interesting, isn't it? Because, yes, on the one hand, the tax take is big. I mean, maybe we shouldn't be surprised that bigger businesses have been targeted in this way. We've spoken to a lot of guests, and Kriti, with Guy, we talked to a lot of guests who've told us that post-pandemic, businesses came out of it, this is, in aggregate, with good balance sheets intact, whereas governments came out with balance sheets that are under pressure. And so I suppose this could be foreseen. And to Kriti's point, other places are doing it as well. But there is always the risk. I mean, if people are mobile, where are they going then, Amanda? Where do they, if they don't like these taxes, where do they head to?
Well, that's a very interesting question because these days you have to ensure that you're living somewhere for a long period of time if you're not going to be resident in the UK. And the UK did actually change its non-domicile regime, which was for those not born here.
The name has gone, hasn't it?
The name has gone. The name was already abolished, actually, in the spring budget, but this government has continued it and expanded the restrictions, so there's a new temporary regime. Where are they going? Well, I think anywhere, really, that they've got a tie to, because actually to want to live permanently outside of maybe where you'd prefer to live is quite a decision to make.
I want to spread this out from the UK as well when we're talking about this global tax policy. simply because in addition to some of the capital gains tax and the carried interest tax that we're seeing, and I'm sure the private equity markets are going to feel the pain a little bit, there's also this question of windfall taxes. You're not necessarily seeing it in the UK, but you're seeing it in other parts of Europe as well. This morning, it's all over Spanish media in terms of bank windfall taxes versus energy windfall taxes. Talk to us a little bit about the efficacy of that strategy.
Well, I think as you talked about businesses having broad shoulders or coming out of the pandemic in a better state, I think that some sectors have clearly done better than others, and those that are seeing perhaps supernormal profits, maybe banking, energy, there is a tendency actually to tax them more highly. In fact, in the UK, we do have a surcharge on bank profits, and the government increased the windfall tax on energy, on oil and gas companies with the energy profits levy. So, and it is, I think, something which is happening more. Governments are struggling to find the funding they need for their public services, and they're looking at those where there are bigger profit margins and working out how to tax them, adding additional percentages to corporate tax.
Well, we talked about the windfall taxes. I kind of hinted at the private equity piece as well from the carried gains tax. How much kind of pain might that add in the private equity market? Specifically, how much of a chilling effect does it have?
Look, I think there was a lot of talk about aligning capital gains for carried interest with income tax rates, which would have been a lot higher, so up to 45%. As it is, the government settled on an increase of 4%, so they are now going to be taxed at 32%. I would say that is about in the mid-range of what was expected, so it isn't going to be too much of a shock. I think it's just below the rates perhaps in New York when you add state taxes in. So it's still not uncompetitive, but it's going to cost them a bit more on the tax they pay on the carried part of their income.
That's the part that matters, is it? The comparison with New York when you're dealing with private equity?
Well, I think everywhere. There's lots of a lot of countries do have regimes for taxing carried interest better, but obviously the UK and the US are primary markets.
It's fascinating, especially at a time when it kind of feels like it's a race to the top of who can tax the most between London and Paris right now, both major PE hubs. We can nerd out about this all day. Amanda Tickle, we'll leave it there. Global leader for tax and legal policy at Deloitte, joining us on the back of the UK budget in the last 24 hours. We thank you so much. Coming up on the program, we go back to the banking sector. BBVA CFO Luisa Gomez-Bravo joins us for an exclusive conversation. The Spanish lender posting third-quarter profits that beat their estimates, all as it awaits an antitrust opinion on its takeover bid for rival Sabadell. That exclusive interview next. Stick with us. This is Bloomberg. We're just shy of 20 minutes away from the opening trades across Europe. You're looking at sentiment that is firmly in the red. Some of this is going to be a little bit of a tech overhang as well from the United States in last night's session, as well as perhaps some of the data that you're seeing out of Asia as well. All net, it means red on the screen for some of these European futures on an index level. Underneath the surface, though, perhaps some green on the screen when you look at some of those earnings that are coming through. Top of mind, of course, is what's going on in the banking sector, specifically when it comes to Spanish bank BBVA. This is the second largest lender in Spain that's coming out with some pretty big numbers here. A profit beat, really citing some of that growth in Mexico, in Spain as well, despite some of the net interest income slowdown that you're seeing. The fee income actually making up for it, not to mention some of those trading revenue as well. Let's dive into some of the numbers and bring in Luisa Gomez-Bravo, CFO of BBVA, for an exclusive conversation. Luisa, a pleasure to have you on the program. We're very grateful for your time. Let's start with some of these numbers here that we're getting out this morning. So much of this growth, so much of these numbers that are being posted is really a function of what you're seeing abroad. And I'm curious, given the interest rate environment that we're in, how much of this is sustainable in some of these emerging markets?
Yes, well, thank you for having me here on the program today. I think the BBVA has posted really a very strong set of results today, with that bottom line in the third quarter reaching the 2.67 billion euros, growing 26% year on year, and reaching a 9-month set of results at the bottom line of also 7.6 billion euros, with again a 28% growth. So again, profitable growth coming from BBVA on the back of very strong core revenues, but also very good gains in efficiency, because you've seen that we have reached a 38.9% efficiency ratio, which is actually the best efficiency ratio of the largest European banks. And again, with that cost of risk being stable and within the guidance. So strong profitability in the quarter and in the year. But also with regards to ROTE, we're posting a 20.1% ROTE level in these set of results. And again, driving shareholder value with tangible book value per share plus dividends. It is a key core metric for us, growing at 16%. So that we believe is sustainable trends going forward because of, regardless of the rate environment, the solid franchises that we have in the countries where we're operating, leading franchises will continue.
Luisa, it's interesting you say there, regardless of the rate environment, can you give us, and I know you're relying more on fee income like lots of other banks are, but can you give us a sense of your the reaction that you'll see in your profitability to lower rates in Europe? Because we do expect the ECB to keep cutting interest rates.
Yes, indeed. And I think here we have generated, I think we've managed the interest rate risk of the banking book in Spain very significantly through our ALCO management actions. Sensitivity to interest rates now in NII is only at 4%. Remember that 3 years ago, it was nearly 15 to 20%. So I think that level of NII sensitivity is the right one, considering terminal rates in Europe at 2.5%. And within that context, we are seeing really very positive dynamics in terms of activity growth in Spain. We are growing at 1.5% year-on-year activity, especially in those segments that are more profitable in SMEs and consumer. So we're very confident in that sense. And of course, you've mentioned fee income growing, cost of risk, definitely should be stabilizing, if not with a positive bias going forward. So all of those things, I think, will be offsetting some of that rate pressure going forward in our Spanish business.
And Luisa, that Spanish business that could potentially grow with an acquisition of Sabadell. Let's talk about the elephant in the room here. And this major takeover bid that BBVA is putting, I believe a deal valued at over 10 billion euros, an all-stock offer for the benefit of our global audience. But Luisa, we are awaiting that decision from the CNMC about whether or not this deal would go through. And I'm curious what the contingency plan is here at BBVA if it doesn't, given how much resistance is coming from the Spanish government. What happens in a couple of weeks to the 850 million euros of costs that are cited in terms of savings of this deal?
Well, I think we're very confident in the deal going through. I think it makes a lot of strategic sense. We've mentioned this in the past. I think banking sector needs scale to compete in an ever more digital banking space with ever-increasing IT costs. And it also makes a lot of financial sense for investors and shareholders as well. So we really do think that this deal has a lot of value creation for all the stakeholders involved. I think, as you said, we're waiting for the CNMC authorization. Yes?
So I was going to say, I mean, it's a fascinating deal as well. And you're right, there are so many cost savings. But you specifically mentioned that dividend and payout benefit. The fact that this is an all-stock offer. Recently at a conference, Sabadell CEO César González-Bueno actually said that a reason not to pursue this deal was because they can match some of those payout offers, some of those shareholder benefits. What does BBVA say to that? What else can they do? What else can you do to sweeten the deal for Sabadell shareholders?
I think the deal for Sabadell shareholders is really very attractive. You saw that with unaffected prices, we're paying a premium of 30% over the price on the announcement, 50% on average previous to that, unaffected prices. And when you look at cash flows and EPS, really we're talking about 27% EPS accretion at the announcement of the deal. And those numbers still are very, very attractive, considering, as you mentioned, the 850 million euro synergies that we're going to be putting in place for Sabadell shareholders and BBVA shareholders as well. So we're very comfortable with the value of the deal, and we think that there is no need and no intention really to improve the deal because it is really a very attractive deal today.
Luisa, we interviewed your colleague, Carlos Torres Villa, over the summer, who had said to us that the biggest enemy of this deal, the biggest risk to this deal, is ultimately time. We've been waiting for months for a decision from the CNMC. We're expected to hear it in mid-November. We could be waiting until the new year, though, for any potential sign, not to mention the risk, as I said, of a veto from the federal government as well. How much time is BBVA willing to give this deal? Is there a red line going into 2025?
Well, I think that we've always said, and we continue to say, that this is on the hands of the CNMC. We need to wait for them to give a view on the deal and authorize the deal. We do still see that regardless of the staging of the deal, this deal has no competition issues. We believe there is no competition issues because we're not going to be the largest player in the market. The market in Spain is very competitive. We've mentioned these things before. And therefore, we do think that this deal will go through with no competition issues, authorization from the CNMC with no structural remedies. That's what we're seeing today. Unfortunately, as you say, time goes by. Time is, as Carlos mentioned, is something that is not good for the deal, and we acknowledge that. But again, this is in the hands of the CNMC, and whatever the time frame, which in any event we're expecting this to be in the next weeks, few months. We will see no competition issues coming from the deal with no structural remedies involved.
Well, Luisa, one of the structures of the deal that's causing a lot of concern, specifically in Catalonia, has been the idea of the job cuts that this may include, some of that which will fuel those 850 million euros worth of savings. Berenberg, for example, saying that this could result in 3,700 job cuts. The labor unions in Spain have been very vocal against that. Is there any room to appease some of that maybe those job cuts don't need to be as severe? Is there any wiggle room there in terms of some of the structure that you're talking about?
Well, we've mentioned that actually this deal in terms of synergies is more geared towards IT and technology synergies than actually branch or headcount reduction. There will be some branch closings, but that's not the main drive of the synergies for the deal. And in any event, we always negotiate with trade unions any approach to headcount reductions, and that would be the case as well going forward.
Luisa, just to finish our conversation, we heard from the management of Sabadell recently where they described BBVA as a Mexican bank but priced in euros. What do you think they meant by that?
Well, I don't know. You should ask them, but I think we're very proud of having, within BBVA, our Mexican business. BBVA Mexico is the best bank in Mexico and probably one of the best banks in the world. Its profitability is outstanding. It's generating an ROE of 27% versus the average of the peers of 16.5%. And we're very strong, supportive of Mexico and constructive going forward. So I think, BBVA shareholders are going to be benefiting from Mexico for a long, long time.
Luisa, thank you very much for your time. We will put that question to Sabadell. Luisa Gomez-Bravo, the CFO of BBVA, thank you very much for joining us. Let's widen the conversation. Think about the broader market picture. Bloomberg's Rachel Evans joins us, Managing Editor for FX and Rates Coverage for the US and EMEA. Rachel, good morning to you. Let's talk about these markets then in a few minutes. And I suppose overall risk sentiment being set by the tech earnings story out of the US. We see US futures looking weak as a result of that. I'm not sure to what extent that filters into other markets, but that seems to be the dominant narrative overnight.
Yeah, no, I think that's absolutely right. Everyone's going to be watching the earnings picture coming out of the US this week very closely indeed. It tells you a lot about AI, which I think has clearly been one of the biggest drivers for the S&P 500 over the last kind of few weeks and months, and will be kind of going forward. I think the other thing to kind of watch, though, today, obviously, we are getting some interesting comments out of Ueda in Japan with regards to the Bank of Japan's path towards higher rates. They're looking very much at kind of sort of better growth prospects there, and I think Ueda in his press conference is being quite sort of hawkish, suggesting that they are going to have to raise interest rates in the next few months. So that's giving kind of the yen a little bit of a pop today, so kind of stronger yen, which obviously when we come to looking at some of the other aspects that have fed into that kind of tech frenzy, thinking about the carry trade that relies on a weaker yen, that's not necessarily going to be something that kind of is as supportive to kind of giving those tech companies as much of a boost as maybe it was a few months ago.
So, Rachel, what is the haven right now? Is it still your traditional ones, your big tech, your Japanese yen, when this morning both seem to be very volatile and not where you want to be?
Yeah, I think the investors are having a lot of issues trying to figure that out. The Swiss franc is still pretty stable if anyone's looking around for things. But I think, from the perspective of the market's thinking about where they want to be kind of going into the next week, there's not a huge amount of options out there. Obviously, you have kind of a lot of risk coming out of the US, so that makes treasuries a sort of slightly more risky proposition. When we look at kind of the UK budget, yesterday we saw the gilt market being very volatile indeed. You know, sort of the biggest trading range for 10-year gilts since March 2023. So bonds are clearly not something that are necessarily as stable as perhaps we might traditionally expect to see. But I think, you know, the kind of, you know, old school havens of kind of buying the dollar, that still probably is where people kind of land, you know, when the going gets tough.
Yeah. Rachel, talk to us a bit more about that gilt story, because during the budget yesterday, everything looked calm in gilt land and other UK assets. And then as soon as she sat down, we got information from the DMO and about debt issuance, and we got information from the OBR around inflation assumptions. And then we saw the volatility in the gilt market.
Yeah, I mean, she couldn't have done much more to really kind of nail the message in the actual budget, but it was really those kind of additional bits of information that provided context to it that kind of upset the market. So as you said, you know, sort of the debt plan, that's going to weigh on yields at the longer end, but also kind of this sort of suggestion from the OBR that because we're going to see higher inflation, that's going to mean that the Bank of England can cut rates less aggressively. So we did see kind of like yields really sort of rising as we kind of saw Reeves sit down, and that will be see how the market does now.
We will see how they open. Rachel, thank you very much. Rachel Evans, Bloomberg's managing editor for FX and rates coverage for the US and EMEA. And Kriti, we're going to get that gilt open in around 6 minutes' time then, so we'll certainly focus in on that.
And certainly how it's going to show up in the currency market as well. Cable's still at a 129, just shy of 130 right now. And this is interesting. So much of the movement this morning in that currency pair has been a function of what you've seen in dollar-yen as well. But the gilt market, of course, could shake all of that.
Yeah, and so many earnings stories to focus on as we get towards the start of trade. We've had the banking sector out with the Spanish numbers we've been talking about, BNP, SocGen, we've got all of that to cover. We'll see how the tech story works its way into the European earnings space. It's not always a slick read across from the US into Europe, but so maybe this is more to do with European earnings stories. We'll keep across all of those at 7:54 here in London, so we'll be back with the market open. This is Bloomberg. Welcome back to the opening trade. Less than 2 minutes to go then until we see the start of trading here in Europe for this Thursday morning. Let's have a quick look at where we left the trading session during Wednesday. And we saw selling into the close, both in Europe, that's in the white line, and in the United States, that's in the blue. And perhaps that would suggest that we would see weakness sort of built in, even if we had not seen some negativity coming through from the US tech sector. But we did see negativity, at least in the shape of a little bit of disappointment on the growth prospects, the revenue prospects for the AI space and the Azure product over at Microsoft. That looks as if it's going to take a chunk out of US stocks later on today. So that's something we're certainly keeping an eye on. The read across into Europe is often difficult there, but we'll certainly watch that and see whether we think there is any direct read across into other AI stories, let alone into European tech stories. So European futures then, Kriti, are negative, down by 0.8% on Euro Stoxx 50 futures. It's pretty broadly spread. We've got a lot of earnings to price in this morning.
A ton of earnings to price in across various sectors. You were talking about the banking sector earlier. Of course, that has been a major focus. So is the energy sector as well. I'm going to start with the banking sector. BBVA and Banco Sabadell. We have two exclusive interviews this morning, both coming out with very strong earnings. But of course, that takeover deal, the announcement that we could get in just 2 short weeks' time from the CNMC, could change the game for both stocks. Nevertheless, consolidation, a theme across the banking sector. Shell, of course, is our poster child for the energy story. They seem to be continuing with their buyback plan. Total, on the other hand, having a very different rate. So it might be a tale of two energy stories there too, Anna. And of course, Airbus breathing a sigh of relief, at least when it comes to some of the analyst commentary. They've reiterated their outlook. This is a positive sign given some of the supply chain issues we've seen in the industrial space.
Yeah, absolutely. You can tell how busy it is when we haven't really mentioned Airbus yet. We've had plenty of news out the auto space from Stellantis and VW. We'll find time to get to those stories shortly, but we'll certainly see how that sector responds to the news flow at the start of trade. This is then the open of Thursday's session. The FTSE 100 a little negative out the gates this morning. The IBEX down by 0.7%, 0.3%. And perhaps we focus a little more on the IBEX today, given those Spanish bank earnings that we've had out this morning. Interesting reporting surrounding windfall taxes in the Spanish media around where they are going to be continued next year and where they're not. So we'll continue to watch how that one plays out. Stock 600 then as a whole down by 0.3%. So the energy space, the banking sector in focus, autos in focus, aviation in focus with those numbers out of Airbus. A lot of moving parts today. And Kriti, that's before you even get to the tech sector over in the United States, Microsoft, Meta, and any read across there. Looking ahead in tech, we're going to get numbers out of the likes of Apple and Amazon. But for the moment, what does the sector breakdown look like?
Well, it's a really interesting one because the top of the pile when it comes to the index contribution is the one company we haven't given a lot of love to, and that, of course, is Airbus here this morning, higher by about just shy of 3% in the early trades, but it is some of your biggest upside movers. But then right off the back of it, you got HSBC and you've got Shell. So again, banking and energy seem to be the big winners, at least when it comes to the UK, but the biggest losers when it comes to France. And from an index contribution as well, at least from the early trades you're seeing in the stock 600, not necessarily in the benchmark French index, is BNP and is Total. And that's really where you're seeing, again, the most movement. Banks, energy, but a regional divide as opposed to a sector one this morning, Anna.
Yeah, really interesting. It does seem as if all sectors are in negative territory, which tells you something about the negativity here in markets. We have the retail sector as the worst performer. Rubis, we haven't mentioned, but that was seen as a weak spot before the start of trade, and indeed it is. That stock down by 5%. I was going to say to the upside, but it's not the upside, is it? But the most resilient sector, basic resources, where we do see some stocks gaining, but only two. Anglo-American is one of them. That's up by 1.1%, but elsewhere, quite a lot of negativity. We don't have all of these markets open yet in their entirety. So the CAC and the DAX taking a little moment to open up. So we'll see how those individual, those markets perform, and indeed some of the building blocks to that. Should we talk about what's going on in the UK gilt market then, Kriti? Because we've actually seen the 10-year yield rising 6 basis points. UK bonds dropping, the 10-year yield rising 6 basis points. That's the headline I see across my screen. We'll get the, there you go, you can see the extent of that. So yields rising 5 basis points or so, let's call it 4 or 5 basis points, it seems, across the curve. Perhaps showing us, you know, it's continuing the direction of travel that we saw after Rachel Reeves had spoken yesterday. And as we were hearing from our colleague Rachel a moment ago, there were these twin worries around the level of borrowing, and that was underscored by what we heard from the Debt Management Office, and then the inflation impact, and whether we need to reprice our expectations around rate cuts from the Bank of England as a result of, for example, higher minimum wages in the UK.
Yeah, it's a fascinating one as well, and already you're seeing a little bit of commentary come out from certainly the PE players on the carried interest piece as well, You're also seeing some of the capital gains pain as well. We should mention, though, in context of the UK, you are seeing yields higher, of course, in the UK. You're seeing yields higher across the rest of the continent as well, especially when it comes to Italy and Spain. It looks like some of the periphery is trading a little bit more volatilely than the French and then German debt is as well. We should also fairly quickly mention, in terms of French things, we are seeing pain when it comes to BNP and Total. Stellantis is actually one of the sole performers in the green, Anna. We've talked about this in terms of their margin really taking a hit this morning, but also still reiterating that going into next year, they may be talking about a buyback. Those shares higher by 0.5%. It kind of feels like this morning, at least from the surface, buybacks may be coming to the rescue.
And the Shell story underscoring that.
Exactly.
Yeah, that's one of the few stocks that's higher on the London market. The Shell share price up by 1.4%.
Yeah, well, let's get an expert on buybacks, shall we? Sharon Bell, Senior European Equity Strategist over at Goldman Sachs, joins us around the table. Every time you come here, I ask you about buybacks, and I can't get enough. How much of buybacks can rescue some of the European stock market at a time when earnings are slowing down?
Yeah, we don't expect much earnings growth next year, 3 or 4% for the next few years for European companies. This year, you're right, earnings, I don't think the earnings season's been too bad so far, but that's partly because the hurdle rate was quite low. People were revising down beforehand. But yes, European companies are using a lot of their cash to give it back to you, either in dividends or buybacks.
Right. It's a fascinating one as well, because we saw this dynamic in the banking sector predominantly, and now it kind of feels like it's showing up in other sectors as well. But I'm curious how much of the buybacks kind of momentum can really continue in the face of things like windfall taxes, for example. Is this even being priced into this market?
Yeah, I think actually buybacks, although they'll be quite strong next year, I do think that they probably peaked this year in terms of their amounts. And one of the reasons for that, it's not just the taxation, although that may be part of it. I think it's also that energy prices haven't been so strong this year. The energy sector is a sector that buys back a lot of shares. So commodity earnings perhaps won't be quite as good. So the momentum in buybacks, which really accelerated, and as you said, we talk about it every time that I'm on, the momentum in buybacks has really accelerated in recent years. I don't think it will go back to where it was, say, pre-pandemic, when we didn't have so many buybacks in Europe, but this year is probably the peak.
Let me ask you mentioned there about taxes, and let me ask you about that in the UK context then, Sharon, because we've seen where this new government in the UK wants the burden of tax increases to fall, and it does seem to be on the larger end of the corporate space, doesn't it? What does that do to your expectations for UK stocks then, or do you draw a line across the channel to other geographies? Tell us your thoughts.
Yeah, look, I think you're seeing taxation rise in many cases, aren't you? In France recently, you've seen taxation rise. It's been talked about a lot in Italy and elsewhere. Governments are under pressure, so taxation is rising, and corporates are also taking a share of that rise in taxation. I would say in terms of sort of UK domestic companies, they may be facing a little bit more taxation, but they're also possibly facing a little bit more growth in the next couple of years too. Data in the UK has been OK. I think this budget is a little bit of a fiscal expansion, which increases demand as well. So I think there are positives and negatives for them.
Yeah, and what about the tariff environment? So we are working our way towards the US election, of course, and European businesses very much in focus when it comes to tariffs that we could see imposed by a Trump administration, if that's what we see. And even without a Trump administration, we're seeing more tariffs being used generally. So the Europeans talking about putting tariffs on Chinese cars really imminently. How are you factoring that into your European assessments then,
So I think tariffs generally for Europe as a region would be quite a large negative, even if it's Europe imposing those tariffs. First of all, if you're imposing tariffs on goods coming in, that increases your inflation, increases your cost for consumers. If tariffs are being imposed upon you, then clearly that's not great for your producer or export business. And Europe is so reliant on global trade. So I think from a sort of relative regional, international basis, Europe really loses out from any contraction you see in trade growth.
What's the bigger geopolitical risk? Is it the relationship with China or is it the relationship with the United States?
You know, I'm quite frequently asked this question. Absolutely perfect question I get from clients as well. I think both are extremely important, I guess, is the answer. I mean, the US is about a quarter of European company earnings are made in the US, so it's very big. But a lot of that is European companies owning US businesses rather than producing in Europe and exporting. But still, the US is obviously a crucial economy for Europe. For China, the exposure looks a little bit lower on paper. Only about 10% of earnings and sales are made in China. But China's been the better growth in up until very recent years. Also, China tends to be a little bit more volatile, so often quite more important for prices. So I think both, unfortunately.
So thinking about China, you take us to the next perfect place for our question to wander to then, Sharon. We had data out of China. It's been such a busy morning that we haven't actually got much mention of the Chinese PMI data. But, you know, shall we celebrate? Manufacturing PMI above 50 in expansion territory. That's the first time in many months that we've seen that. And some people are joining the dots to the stimulus, others saying it's too early for that, more stimulus perhaps to come because it still wasn't the kind of blowout number. What does all of this mean for Europe? Are we still seeing European businesses very tied to what happens in China, or are they working on reducing those ties?
So I do think that European businesses, they spent a decade, maybe 2 decades, building up exposure to China, definitely. And I don't think they're doing so much of that now, partly because China growth has been much weaker. You know, these most recent figures notwithstanding, pretty much every other data point has been extremely weak. So that's been very weak, but also the geopolitics as well, and the potential for tariffs and trade wars, etc. All of that, I think, is leading to a bit of a reshoring either back to Europe or to the US. But, you know, obviously there is a big China stimulus coming through now. China data has been extremely weak, but probably bottoming at the moment, and you will see better growth next year, on our view.
We have so many profits right now kind of still sloshing around in the system. Even if the earnings are slowing down or even staying kind of stagnant, it feels like there's still corporate profits that are perhaps a little bit of an excess on certain balance sheets. And I find it interesting that some of it is buybacks and some of it is dividends, some of it is payouts. But then it's also, and then some of it's going to taxes, of course, but then it's also consolidation. And we talk about this a lot in the banking sector, but it feels like other players are looking at this as well. What gets in the way of that? Do you foresee more consolidation? Is that something people should be trading on, this M&A pickup?
I think, generally speaking, sort of corporate activity has been very low in recent years. You see fewer IPOs. You've seen, certainly last year, very little M&A. M&A started to pick up this year. And I think that once Now interest rates have peaked and started to come down. That's very helpful in terms of encouraging businesses to think ahead and say, OK, now I know where interest rates are peaking and where they may go in the next year or so. So I think that's helpful. And I think that European businesses in particular, their valuation discount to the US is very, very large, as we discussed before. And there's not a lot of top-line growth around at the moment. As we just discussed, earnings estimates coming down. So how are you going to generate that? You can often generate that through things like more aggressive use of cash. You can do buybacks, or you can perhaps buy something, cut costs, expand your market share, etc. All of those things are open to you.
It's a shame Guy Johnson isn't here to talk about PE multiples. You would have baited him right there. But I think she makes a crucial point in this kind of pickup in M&A activity as well, because look at every single bank earnings we've had this morning. They've talked about fee income turning to the investment banking. But the more you do that, the more deals you get, the more antitrust scrutiny you get. And we talked about it in the context of Spain, but you see it in the States. We had the DOJ on a couple of weeks ago. And you see it in other sectors as well. So it's almost kind of a catch-22, but what you do with all that money.
Right, yeah. So if you go more for fees, you go for more for M&A, what's the climate like for that M&A to actually get done? I want to take us to another part of the universe, Sharon, and that is what's going on in gilt markets. We talked about the budget and what this means in terms of tax. We do see yields ticking up again this morning, up by 6 basis points at the 10-year horizon. You know, and the rest of Europe is also moving higher, but the UK is moving a little more in terms of those yields, so up by 6 basis points now. What do you think this is telling us? I was looking to see whether on the FTSE 100 we were seeing those rate-sensitive stocks weakening, and perhaps we'll see a little bit of that. What do you make of that slightly higher gilt environment?
I agree. So I did say that, I mean, we've upped our GDP forecast for this next year for the UK a little bit because of this fiscal expansion. But the negative side of the fiscal expansion is there's more borrowing that's needed for it. So there's more borrowing, a little bit more inflation, because an increase in national insurance for employers is a little bit inflationary. Increase in the minimum wage is a little bit inflationary. All these things are a little bit more fiscal spend is inflationary. The bond market's a little bit worried about that. So bond markets everywhere have been selling off. You're right. Yields have been rising, but I'd say particularly in the UK.
And I know this is maybe going a little outside our comfort zone, but how much is worry about the bond markets and issuance and supply, and how much is just factoring in, OK, the Bank of England won't cut quite so much because of that?
Look, I think both, again, a little bit is the answer. I don't think it's as worried about the fiscal position as perhaps bond markets in the UK were a couple of years ago. But there's definitely been a slightly fiscally expansionary budget, a little bit inflationary, a little bit more growth and a little bit more borrowing. And all that mix, it's not perfect for gilts, and that's why they're selling off.
All right. Sharon Bell, Senior European Equity Strategist over at Goldman Sachs. We thank you so much for joining us around the table. Let's go to a quick check on the core six, the main stocks that are, of course, potentially moving this market in terms of the heavyweights. Red on the screen across the board. You are seeing the biggest hit, it looks like, in Ferrari, actually, but right next to ASML. It feels like ASML may be that tech read-through that we got over in the States as well, despite being a chip equipment maker and not a cloud services. But nevertheless, sentiment certainly in the red. Let's go from the macro to the micro. Get a little bit more of an update. Joe Easton, I'm sure, kind of trying to drink out of a fire hose this morning. Joe.
Yeah, there's plenty to choose from today, Kriti. Firstly, starting in the bank, some big moves over here. We're seeing SocGen over in France jumping. This is mostly due to their trading business, fixed income, looking really strong. We've had some news of some management changes over there as well. But take a look at BNP Paribas, absolutely slammed, down 6% in early trading. Now, analysts over at Citi are pointing to a weakness in some of their capital. Also, they do have a vehicle loan business as well, and Citi pointed to some declines in sales for that one as well. ING coming down in Amsterdam, another decliner in the banking space. Net interest income does seem to be the weak line on that one. Then we have also got the banks over in Spain reporting. There are several out today, and the ones that we've had with management on the shows this morning. Banco Sabadell, that one coming down, and BBVA, of course, the company that is looking to buy Sabadell in that hostile takeover situation. Both of them weakening. Both companies are heavily exposed to the decline in net interest income as well, which is a bigger problem in Spain than the rest of Europe, notably, for those lenders. Then in terms of Airbus, this one is looking more positive. Finally, a bit of good news for this one. It has been hit pretty hard given the production issues there, and they are seeing a bit of an uptick in orders, potentially meaning some of that is now starting to ease finally for Airbus. Then over in semis, two very different moves in the market this morning. Well, actually, ST Micro actually has paired its move since I've come over to the studio. That one was down in early trading. Ikestron, meanwhile, jumping. This is in semi-machinery. It is down around 40% year to date. It's kind of coming back following a sales result there. And ST Micro looked really negative given the exposure to the decline in the autos market and EVs, but actually potentially all that priced in at the moment. Quickly, ABI is the maker of Budweiser. That one is declining. There we go, actually adding to the losses following the slowdown in Bud Light sales. Smith & Nephew, the worst performer on the entire European market today. Medical tech in the UK weighing on the FTSE 100 following week. So finally, we've had way too many earnings, haven't we? So we'll do a morning call. Burberry upgraded, the second upgrade in 2 days for Burberry. Yesterday, it was the analysts over at Barclays. Now we've got HSBC upping Burberry to buy, potentially signalling a rebound. We're up 1.7% on that luxury stock this morning.
Joe, thank you. Joe Easton from our equities team with an update on, yes, all the earnings and also some broker moves. Coming up on the programme, we'll get back to the Airbus story. That's certainly one we need to dedicate a bit more time to. Airbus supply chain turmoil continues, but the plane maker is signalling confidence in the path forward. We will bring you the details. The share price moves a little bit higher this morning in contrast to the rest of the markets. This is Bloomberg.
We have difficulties month after month to execute on the ramp-up. We have a quite difficult end of the year ahead of us, the year-end rally, as we call it, as we anticipate to have more than 200 planes to deliver in the last 2 months.
That was Guillaume Fauré, the Airbus CEO, of course, talking about the performance of the business. The world's largest plane maker has reaffirmed its 2024 delivery goal, underscoring the focus on ironing out supply chain glitches that have hampered production plans. Let's get further into this story as the Airbus share price ticks up this morning. Bloomberg's aviation senior reporter Sid Phillip with us on set. And Sid, you know, this is a business that, given the troubles at main rival Boeing, should maybe be doing better than it is or having a smoother rise than it is. Talk us through the challenges they still face.
Yeah, so Airbus has really struggled to come back from the pandemic. I mean, they had very ambitious growth plans as they ramped back up from the pandemic. But unfortunately, the supply chain hasn't really been able to keep up with that. And that's really been the biggest challenge for Airbus. So they've set themselves really big targets, and then they've sort of come short because of the fact that they aren't able to sort of meet the, like, supply chain isn't able to meet the demand and isn't able to ramp up as fast. So they've ramped up hiring, but the supply chain is still struggling with workers, is still struggling with supplies, raw materials and other things. And so that's been a big challenge for Airbus. And, I mean, Airbus is, like, there was a lot of expectation that Airbus would downgrade its forecast for the year, and that did not materialize. So they've set themselves up a huge challenge of building around 240 planes in the next couple of months, in this current quarter. And so it's a big challenge for the plane maker, especially as they sort of try and get those deliveries out, because, I mean, there is a lot of demand for those planes, and unfortunately Airbus just hasn't been able to meet that demand.
Talk to us about the management changes.
So Airbus they've talked about how they're going to get a new CEO for their commercial aircraft division. They've talked about bringing in Lars Wagner, who currently leads engine part maker MTU, and he's going to join Airbus in 2026. That division is currently led by Christian Scherer, he's a veteran of Airbus. He's been there for 40 years. And so he will sort of hand over to Lars, and essentially Lars is more an operational person, whereas Christian Scherer has been more of a salesperson. So I think that also sort of addresses what the challenges Airbus faces in terms of trying to get production back up, trying to get production going. And that's what analysts are talking about, how they're getting a production person in charge of the commercial aircraft division.
A lot to digest there. Bloomberg's Sid Phillips walking us through the Airbus story. Of course, one of the major movers to the upside this morning. Let's talk about the other side of the coin here. And the major kind of underweights, Microsoft, Meta, both taking a beating in pre-market trading in the United States here this morning. Microsoft shares down about 3.7%. Meta, shares down about 3.8% as well, all weighing on the futures picture. Let's focus in on those big tech results. Take a listen to what Microsoft CEO Satya Nadella had to say about their outlook.
All up, our AI business is on track to surpass an annual revenue run rate of $10 billion next quarter, which will make it the fastest business in our history to reach this milestone.
For more on this, let's bring in Bloomberg's executive editor for tech, Peter Elstrom, who I'm sure is also kind of drinking out of a fire hose this morning. Let's start with the Microsoft story as well. Walk us through the spending effect.
Right. Well, we're beginning to get this picture of what is going on with the technology companies right now. We're going through a very intense week of earnings results. We got Alphabet yesterday, along with AMD and now Microsoft. And one of the big surprises that we're seeing is exactly what you're alluding to. These companies are spending so much money on CapEx right now as they make big investments in AI. In particular, they're building new data centers. They're buying a lot of chips from NVIDIA, which are very expensive at this point. And at first, this report from Microsoft looked pretty good. Revenue was up 16%. The cloud computing business was up 34%. That seemed to be pretty strong. But a lot of what was a challenge for them is as they talked about the spending going forward and also the growth in the future, it looked a little bit softer than expected. It looks like the Azure cloud computing revenue business is going to slow down just a bit. It's only by a couple of percentage points, but because investors have seen all this capital spending going on, record capital spending for the company, they want to see those numbers going up, not slowing down at this point.
So there's a sense that maybe anything to do with AI is potentially priced for perfection right now, Peter, and you've got high expectation and you need to deliver on it. On the other hand, though, it's almost a nice problem to have that Microsoft can't quite live up to can't quite supply all of the demand around data centers. So it's not as if they're giving us the message that there isn't the demand for the AI product. It's just that they can't keep up with that demand.
That's right. They're supply constrained at this point. So they're at record capital spending. Their capital spending was up 50% from a year ago. The CFO, Amy Hood, though, said that they are having a hard time getting out the data centers, building the data centers as quickly as they would like right now to be able to meet the demand that you're talking about as they try to sell these AI services to the customers around the world.
Let's talk a little bit about Intel as well, sticking with that chip space. We talked about the kind of outperformance of Microsoft. Do we see it show up in some of the chip makers? I know completely different businesses, but that tech sentiment, does it show up there?
Well, everybody wants to find out what's going to happen with NVIDIA in particular. We're going to have to wait a few weeks for NVIDIA right now. We did get AMD yesterday. AMD's results were a little bit light, but it's not clear whether that's a slowdown in demand for some of the AI chips or whether they're not gaining as much share against NVIDIA as people had anticipated. For Intel, I think the story is much more basic at this point. They've been having so many financial problems. They're really struggling to be able to get the CHIPS Act money that they want to get. They have troubles in their foundry business, too. So people want to see that Intel is regaining its solid financial footing so that they can build on some of the potential that they've got in foundry and also in their basic processor business. Moving into the AI space for them is an aspiration, but they're pretty far away from that at this point.
And if we circle back to some of the earnings we had overnight, Peter, Kriti, we started by talking about Microsoft and Meta, both under pressure pre-market because of earnings.
Right.
The Meta story, are we back to worrying about Mark Zuckerberg and how much he wants to invest in bright, shiny new things? That seems to be a perennial concern.
I mean, when Facebook came out, it was a very capital-light business. You didn't have to spend a lot of money on these things. And now we've seen him spend billions and billions of dollars on the metaverse, his aspirations for the metaverse. AI is the next fixation for him. So he's warned investors that he plans on spending very, very heavily going forward. Again, the stock has done great this year. It's up more than 65%. It's done very, very well. But they like to see him cash in on some of those profits rather than continue to spend so aggressively into the future.
All right. Bloomberg's executive editor for tech, Peter Elstrom, staring down the barrel of these pretty big hits from Microsoft and Meta in terms of the pre-market. Coming up on the program, we switch back to the banking sector right here in Europe. BBVA and Banco Sabadell shares both down in today's session, despite both having net income beats. It looks like their lending revenue is what's getting the hit here. We're all going to be speaking to the Banco Sabadell CEO next, as, of course, we await a decision on the takeover bid from BBVA. A lot going on, 2 exclusive conversations. Everything could change in just 2 short weeks. Stick with us. This is Bloomberg. This is the opening trade. We're about 30 minutes into today's session, seeing red on the screen across the board here. It looks like a little bit of weight in the European session, although pairing some of the losses that we had seen, it is ultimately a story of what's going on underneath the hood. You are seeing some of the pain in some of the energy stocks, some of the banking stocks as well, and that's where I want to go next. Of course, Spanish banking is top of mind as we await some of news on the BBVA Sabadell deal, but also both companies coming out with their earnings this morning, especially in a decelerating rates environment and a takeover takeover bid. There's a lot to discuss. I'm pleased to welcome the CEO of Banco Sabadell, César González-Bueno Meyer, joining us this morning. César, a pleasure to have you on the program as always. Let's kick it off with your earnings as well, especially at a time when we're talking about decelerating interest rates, this kind of pressure on margins. Walk us through your numbers. How are you pushing back or making up some of those losses in interest income?
Well, the first good news is that we are 26% up year on year on net profit. It's a record. In the first 3 quarters, we've made as much as in the whole year of last year, and our return on tangible equity is also at records high. Why is this? Of course, negative interest rates are having an impact, that for sure. But in our case, it's much milder. 60% of our activity with clients, of our assets with clients, are at fixed rate. On top of that, we have managed the book in order to make it more resilient to downturns. And furthermore, we are having TSB, our bank in the UK, picking up because of the caterpillar and other effects. So they are, for the first time in this quarter, up in terms of net interest income. So all in all, record year by far, and a very good equity story, I have to say.
César, it seems that the market is a little concerned about the net interest income, but you've responded on that. Also, perhaps a little concerned about hyperinflation in Argentina and whether that is having an impact on your business. What is your experience in that part of the world?
Well, our experience in that part of the world is very limited. Contrarian to BBVA, who has more than 70% of its income in emerging markets, in our case, it's only 4% of our equity, which is in Mexico. So we are basically a Spanish bank with a big footprint in the UK through TSB, and therefore all that doesn't have an impact. All that the decline, both in results, but also the shakiness of the exchange rate of the different currencies is not affecting us at all because we are not present in those markets.
OK, yes, apologies. Sorry, this was more of a thing that's affecting the Spanish banks as a whole rather than you specifically. But that takes us nicely into the conversation around M&A and your pushback against a BBVA acquisition. You've said recently that BBVA is a Mexican bank in euros. What did you mean by that?
That's very simple. 50 to 60% of their profits come from Mexico, and more than 70% of their profits come from emerging markets. So in reality, it's not fully a European bank. And that's why I think consolidation in Europe is something that we should all look forward to, but it should be among European banks.
Well, César, that's the argument from BBVA, with all due respect, that with the combination of Sabadell, you have the ability to compete on a larger scale across Europe and not just in Spain. I'm curious, though, in terms of your contingency plan, you've been very vocal that this is not a merger that you're looking forward to. But given that there could be a scenario where BBVA has a majority stake in Sabadell, what is your contingency plan?
I don't think there's no need for contingency plan. I think it's not going to happen. The price is not there. It's not friendly. And there's a major rejection for society at large. Why is the price not there? You have to take into account that just in the next 18 months, Sabadell is going to return in terms of capital 30% of its market value at 2.9 billion, which is what we have committed to distribute between this year and the beginning of next year. I mean, between next year and the beginning of 26. That's 2.9 billion is 30% of our market cap. That's hard to beat. And that means that in the end, I think our shareholders are going to consider that there's much more value creation at this bank, which has been top performing for the last 4 years and still has a long way to go.
Well, César, talk to us a little bit about how you can make this more kind of interesting. And at a conference, an investment conference, you've recently said that there's potential improvement to your payout plans, given that the BBVA offer, in your view, is not at fair value. What is fair value, in your opinion?
Well, fair value is always a moving target. I think that in relative terms, and that's what every CEO will always say, we are undervalued. But you only have to see the trend of Sabadell during the last 4 years. We have multiplied our value by 5.2 times. That's a 420% increase in the course of 4 years. We're best performing bank in Europe, across Europe, and best performing stock in the Spanish stock. And this trend is continuing. This year, we are up by more than 60% and only 4% since the offer occurred. So we are in a very positive trend that hasn't finished because we are still improving our processes, our performance, our commercial activity, our cost of risk. It's banging from all engines and lots of good things to come.
Well, lots of good things to come, but César, with all due respect, the market doesn't necessarily see it that way. Yes, your stock is up a pretty decent chunk in the last year, no doubt about it, especially after this kind of takeover offer from BBVA. But we're showing a chart on the screen right now that talks about price-to-book ratio for both BBVA and Sabadell in the last 10 years. The market is saying that it's not reflected what the outperformance of Sabadell actually is when it comes to this particular metric. And I'm curious, when it comes to your view, what the market is missing here, if not the ability to, with BBVA, surpass the market share of the likes of Santander. Is that not appealing to you?
No, I don't think size, for the matter of size, it's anything appealing. The most performing bank in Spain, it's one that is smaller than even us. So size and profitability are not necessarily correlated, and as a matter of fact, we see very often that it's not. Especially if it is in different places of the world, in different markets. So concentration in certain markets certainly helps. But it gets to a point that it affects also competition. 1 in 2 SMEs is a client of Banco Sabadell in Spain. And our net promoter score, which is an index of satisfaction, is extremely high. It's #1 also. So we are correcting all the elements that in the past didn't allow our performance to be so spectacular. But as I said, we've multiplied by 5.2 times the value of the stock in 4 years. And when there is a trend, there's always a catch-up. Every year we have been adjusting to the prospects of the financial advisors and the analysts. Every year we have catched up. And now we have a significant upgrade to 225 in their view, and that's what we are aiming. And we usually catch up in the course of a year. So the market is giving us more value, but it takes time, and we are aiming for that.
Well, César, first off, with all due respect, you mentioned that BBVA is a smaller bank. It's not in terms of market share for deposits, customer loans, and mortgages. That's just coming from Bloomberg Intelligence Research. But you mentioned that key piece, which is time. And this is something that both the folks over at BBVA, Carlos Torres Villa, the chairman, as well as the CFO, had recently said on our program. Take a listen. I just want to play what their comments are to you, what they said about that factor of time. Luisa Gomez Bravo, take a listen.
Time is, as Carlos mentioned, is something that is not good for the deal, and we acknowledge that. But again, this is in the hands of the CMC, and whatever the time frame, which in any event we're expecting this to be in the next weeks, few months, we will see no competition issues coming from the deal with no structural remedies involved.
César, that was the CFO of BBVA saying that she sees, no issues to this deal, but that time is ultimately the enemy of this. How long are you willing to fight after the CNMC decision in, say, 2-3 short weeks?
Well, the CNMC decision is probably going to extend. And what we expect is that the deal will only come to the market and the tender will be open around the summer next year. So it's not in our hands. It's exactly how the process of approvals works. The competition issues that are identified are very, very significant. As I said, 1 in 2 SMEs is a client of Banco Sabadell. So therefore, the fact that we would disappear would affect significantly competition, and that's putting time on the table. During this time, what has happened since April, since the offer was on the table, that BBVA is down by around 14%, 17%. It's oscillating there. And we are up by only 4% in line with Caixa and with Bank Inter. So we are all following the market, and we are exactly where we stood at the beginning when the tender was proposed. I mean, when the offer was proposed, and then with the hostile takeover, happened, and they are down in line with the Mexican peers and the evolution of the peso. So in reality, yes, I agree that for them, time is not helping because the performance of our stock in relative terms is significantly superior. Time doesn't help them. That's true.
César, can I ask you about something else, which is taxation in the Spanish market? We're seeing reports in Spanish media that the windfall taxes on energy in Spain might come to an end soon, the end of this year. But on the banking sector, we might continue to see windfall taxes. What do you understand is the government's position there?
No, I think what has been published is exactly what you're saying. The windfall taxes in banking are going to continue, it seems like, but they're going to be relatively milder to what they have been until now. So that should be, in relative terms, some improvement.
César, thank you very much for joining us. Banco Sabadell CEO César González-Bueno, Mayor, with an update on how the performance of the business is going and the pushback against that attempted takeover by BBVA. We thank him for his time, an ongoing story we continue to track. If you would like to talk to us about what you think of Bloomberg TV programming, then we would like to hear from you. We put together a short online survey. You can click the QR code that's on your screen right now to tell us what you'd like to see more of on Bloomberg TV and anything you'd like to see change. We will use your feedback to make the best programmes that we can, of course. Much more ahead. This is Bloomberg.
You can have more control and less growth, or you can have less control and more growth. If countries trust each other more and they build more European champions rather than each country having its own national champion. So I think what Europe needs to think is to start thinking about its common interests rather than the interests of each of the countries, right? I mean, one problem with the European economy is that it's fragmented at the national level. I'll give you one statistic that I think is really interesting, right? In Europe, there are over 30 telecoms operators. In the US, there are 5 or 4. In China, there are 5 or 4. Essentially means that European firms are smaller. I think what it means is that it's less global and more bipolar.
Citadel's head of economic research there discussing Europe's struggle to unite and how it's leading to a more bipolar world between the United States and China. This is, of course, as we zero in on the relationship between the United States and China. It's part of our daily series on the issues facing Europe in the battle between Kamala Harris and Donald Trump. We're just a few short days away from when Americans hit the voting booths. Our next guest is an expert on China, Robin Niblett, distinguished fellow over at Chatham House. He's also author of the book, The New Cold War, How the Contest Between the U.S. and China Will Shape Our Century. Robin, a pleasure to have you on the program. We talk about this often from a market's perspective of whether Europe is more responsive to the China side or to the American side in terms of where they get kind of caught in this trade struggle. Your perspective?
Well, my perspective is they've got no choice. They'll get caught on America's side, especially if we are in a new Cold War, which is certainly my interpretation. Europe relies on America even more as an ally and for its own protection than it did for a long time, really since the end of the last Cold War. And so China, to the extent that China is supporting Russia in its war in Ukraine, the Europeans get pulled even further onto America's side. Obviously, that worked quite nicely in the Biden administration. They've been relatively aligned, even though the Biden administration has done some things that have upset the Europeans, the Inflation Reduction Act being the clearest example.
Yeah.
But despite that, at least they've been reliable allies, and they've tried to kind of respond to China together. The fear and the danger is that if you have a Trump administration, he will respond to China separate from Europe and will leave Europe to its own devices.
When it comes to those kind of retaliatory tariffs, though, it feels like this is an instrument that has really been used initially from the United States, but that Europe is kind of trying to learn how to do. It also comes in the context of this idea that we do have, I believe, an envoy today being sent to China around perhaps discussions around these EV tariffs. Do you think in the fallout of U.S. and China, specifically around raw commodities, you could start to see the EU take a more pro-China approach?
I think pro-China would be too strong a term. One problem Europeans have is that if the United States imposes strong tariffs on China, there's a blowback effect into Europe, because in essence the Chinese then end up exporting more to Europe, which is their largest market in the world, the US being roughly third if you count ASEAN as a whole as their other major trading partner for China. So the Europeans are almost forced into at least mirroring somewhat the US trade policy towards China, so they don't then become the market, the alternative market. However, as we saw with the EV tariffs, they've tried to take a sort of legal approach. Yeah? We're going to discuss with each company, and to the extent that they engage in the subsidy investigations, we will tailor the tariffs. And they've been anywhere between adding 35% and 17%, very different from the Harris administration. So they're trying to say to China, look, we are a reliable trade partner, but we're not going to be rolled anymore. And if you talk to Europeans who operate in China, including a lot of the companies that try to sell into there, they feel the China barriers to their trade are massive and have not reduced. It's fine if you're a European company operating inside China, maybe those barriers aren't as strong, but there now you're now getting outcompeted by the Chinese partners, as we've seen with the EV market and Volkswagen and others.
Yeah, and Robin, it does seem from what you're saying then, if we're in this new Cold War, it does seem like we are going to be in a much less globalised world than we've known over the last few decades. How far do we unwind that globalisation?
The way I think of it is it's almost like sort of reversing into a new Cold War. You know, the two sides got very close together. I think the Chinese knew well in advance at some point the US was not going to allow a peer competitor that was a one-party Communist Party state. And they've been kind of hedging and de-risking for a lot longer than the Americans have, or even the Europeans for that matter. How far do we go? Look, I think we're in the first chapter. The Biden administration, and if there were to be a Harris administration, are in a sort of one-way ratchet where each new technology, if it's assessed to have a security dimension, gets added to this famous kind of fence, yard and fence. You know, there's meant to be a small, restricted area of technologies, but it's already expanded beyond AI, beyond semiconductors, beyond quantum, to EVs, to probably going to cloud computing. It's in all sorts of areas. So I think we're at the front end of that ratchet. But if a Trump administration comes in, it's going to be less about sort of security technology and more about just trade. And their reglobalization, which is the term that's being used a lot at the moment, is more about other markets taking advantage of the contest between the US and China.
Yes.
Southeast Asia, for example.
Yes, and we've done quite a lot of research. I think Bloomberg Economics talking about the sort of unaligned countries and the way they're able to pick up the slack. So, Robin, from all we've discussed, I mean, is it too late that we go back to what we would have seen as the status quo with two different contrasting systems in the United States and China? I mean, there could have been we could have written a story that would allow those two to coexist in different regions of the world. Yep. Why does that not work?
It doesn't work because we're getting too sort of political about it, but I suppose I have to be. China and the US, fundamentally, their leaders fear each other. And fear is a much stronger driver emotionally than opportunity. Win-win, we'll lose out to lose-lose if that is the dominant fear, and that's the direction we're heading in. So, look, there are sectors where, you know, the US-China trade is still at its probably second highest ever in 2022 was the highest level ever of bilateral trade, dropped by about 100 billion in 23. But the direction of travel is one where that bilateral trade, other than in farming, you know, some other furniture, all sort of areas where it's not security related, is going to get harder and harder.
And Robin, just briefly, do you fear it will take a long time to settle the result of the US election? In theory, we know next week.
Look, you have a lot of close states in the swing states. All of them could swing one way or the other, in which case I think it will get resolved relatively quickly. But if it's down to one or two states, we could be in for a long, long ride.
OK, Robin, thank you very much. Thank you for your time. Robin Niblett, Distinguished Fellow at Chatham House, author of the book The New Cold War, How the Contest Between the US and China Will Shape Our Century. A great voice to have as we gear ourselves up for that US election next week. As we just mentioned, Bloomberg has learned that the European Union is sending officials to Beijing to hold more talks aimed at finding an alternative to tariffs on EVs from China. For more, let's bring in Oliver Crook in Berlin, who's been following this. Oliver, negotiations also ongoing between EU China on EVs. What is the latest?
Yeah, so listen, Anna, we know that we're going to send, we understand from people familiar, yet another delegation to China to continue these discussions and finding ways to potentially circumvent these tariffs and continue these discussions. We should say, Anna, that there have been 8 such talks in the lead up to these actual tariffs coming into force, which happened only yesterday. And now that they're in place, it's going to be a lot harder to break through them than it was previously before. But from what we understand, what they're looking at is potentially an arrangement that would put sort of caps in terms of volumes, potentially prices, potentially quotas that would sort of go around the tariff regime that currently exists. We should say, though, that of course this is very, very complex. It has to all be WTO compliant. It has to go with what the sort of EU and the desires that they have there. And the Chinese, for their part, they want a sort of arrangement that would blanketly cover all of the car makers, which makes this very, very complicated. So an encouraging sign maybe for the automakers that these discussions are going on, but I'd say that at this point it's still a very long shot.
Well, a long shot, but then at the same time kind of being balanced with some of the lower local labor negotiations as well. Ollie, what do we know on that front?
Yeah, so listen, you have also the negotiations that are going on between Volkswagen and the leaders of Volkswagen and the unions there. And we have, from what we understand, the sort of opening gambit, obviously, from management earlier in the week, which included radical action of potentially closing factories, potentially cutting wages across the board. What we understand now, hearing from the chief negotiator from Volkswagen, that if they can achieve their financial goals, they're actually open to potentially not closing the factory. So this was sort of the opening gambit we got earlier in the week. As these discussions go on, we're going to get slightly more contours in terms of where the two sides are. The next round of negotiations, and this is the crucial date to watch, is November 21st, because if they do not get a breakthrough by then, we have heard from the unions that they could start striking warning strikes for Volkswagen across the board starting on December the 1st. In terms of sort of all of the news that we got out of Volkswagen, because we also had their earnings out this week, we've heard now from the analysts who have given now their perspective on all of this. I thought this was an interesting note from Bernstein this morning, entitled, which maybe sets up the stakes for you here, Conundrum at the Last Chance Saloon for Volkswagen, saying that basically management's bold commitment to tackle costs at Germany is very welcome, but its resolve is under fire, is yet to be tested, and they still feel that there is a large chasm between intention and execution, which is perhaps why they sort of lowered their price target on the stock this morning.
Certainly something we're going to be keeping a very, very close eye on. Bloomberg's Oliver Cook, we thank you so much for breaking that down for us. Of course, Anna, it's showing up in these markets here, red on the screen across the board, and the DAX, of course, not really getting any relief either. Some of that a function of the automakers that Ollie was just talking about, down about 0.4%. In the meantime, plenty in the rearview mirror, but plenty up ahead as well. We've got plenty of data. 10 a.m. UK, we've got Euro area CPI, and then the focus is back to the States in terms of the data, PCE, jobless claims, and then plenty of, well, central bank speak. And even more earnings in the States. I don't even know where to look, Anna.
Yeah, absolutely. We've got plenty more earnings to come. And we'll be pivoting, won't we, between the US data picture and the US earnings story, I suppose, as we go through the session. So PCE, you know, inflation still matters, apparently. So we'll keep watching that one. So we're told. So we'll keep watching that one. But on the earnings side of things, it has been Microsoft and Meta that have sort of set the tone overnight. Are we going to have another day of that? We're looking ahead to numbers out of Apple and Amazon. And, of course, Amazon takes you very close to that cloud conversation. We wonder... And the AI conversation, we wonder what they're saying there. But with Apple, first glance of how the new iPhone 16, the smartwatches and the AirPods are doing. Yeah, that business spend is going to be really, really crucial, whether it comes from, do you actually see it in hardware, like for Apple, or do you see it for the cloud services? Net, a lot of macroeconomic signals ahead. How is that going to show up in this bond market as well? We're looking at a 10-year over in the States at about 427, 428 if we're feeling good. 2-year at about 416 as well. And continued pressure on the dollar on all of it. Risk sentiment is not positive this morning. Stick with us. That does it for the opening trade. This is Bloomberg.